Hey everybody, this is Jose Blasco. How are you everyone? I'm starting with just a few seconds of delay because I was having a few sound issues. So we are about to get started, but please let's have a quick sound check. Please go ahead and confirm with a quick message that you hear me well. That would be appreciated so I know all is good. I believe so. But again, that was the reason for the slight delay. Just a few seconds really, but no, normally like to be there a few seconds, 1 minute ahead of time so we can do this sound check without having to wait. It seems that all is good. So I think we are ready to begin, and therefore we are now starting the session. So welcome everybody. Thank you, Joe, and everyone. Thank you, everyone. Today is October 17, 2021. My name is Jose Blasco. This is a top session. We're going to be talking about top and the use of the tool. Before we get started, disclaimer on the upper left side of the screen. Please read it carefully. As always, this is important information. Make sure you don't skip it. You read it completely. I'm counting on you to do that. The format of the session today, as we do on the Sundays, it's to go ahead and spend a little bit of platform time. Of course, often platform time also implies a little bit of trading lectures because in order to understand how to use a trading platform, sometimes we need to talk about trading techniques or specifics about trading. So it goes hand in hand, and for sure, questions and answers and more. That's the plan. So I have specific topics I would like to cover today, which I'm going to discuss in a moment. But also I have a question. Actually, it's two questions really that were sent by Mark, which I can see is with us in the room. How are you, Mark? How are you, Ahmed? Everybody, good to see you. And so we'll start with the top session, and as we are done with the subject that I plan to address today, I'll take care of Mark questions, and of course, if you have any other question, so the chat box is available there for you to type, and I indeed welcome any question you may have, and happy to help, guys. So don't be shy, and let's do this together. So let's begin. So here is top, and as you know, we have a help menu where when you click help, or you simply press F1, this brings you to the help menu page that you can see on our site. Okay, so here there are many things, and little by little we'll be addressing them all and more. But today I would like to continue with a little bit of the basics, because when we get into more advanced type of tools, often we will refer to more basic functionality. So we are building from, kind of like the foundation up. And the tool I would like to discuss with you today is the option chain. Okay, which you may say an option chain that there is not too much to talk about, but the reality is that there is, as you will see, because this is a pretty advanced option chain, the one that is built on top. And I would like to, help you to, move around so you understand well how to use it efficiently, putting on the side that then in the end you may use, the strategy builder we saw in a prior session. You may use spread select, or even directly the risk graph, or even the projection tool to plan your trades or tweak your trades. But at the same time, many of you may have traded options for a while, and your natural starting point when you are planning on an options trade is the option chain. Or maybe you just want to analyze, a chain of a new market that you never traded before, and you want to take a look. So again, the option chain, to be honest, while it's a simple tool, does give you a great view into the market. Fernando, how are you, my friend? It's good to see you. So let's begin. Okay, so here is top, and when you look at all the buttons we got there on the left, one of them is the button chain, where, as the name suggests, when you click, it opens an option chain. Okay, good. So as I begin with the option chain, first thing I'd like to do is to ask you a question out there. I'm sure that many of you have been exploring the option chain, maybe using it. How is it going so far with the option chain? Do you have any specific questions? So that way, apart from discussing what I think is useful, maybe there is any additional, question or observation that you had that you would like to share now, so I can incorporate that into this teaching. Happy to do so. Okay, so please share with me on the chat box your experience so far with the option chain, even if it's just like, okay, so I looked at it and that's it, or no problem. So feel free to share with me on the chat box, so then I know. Thanks for that. So anyway, so I'm gonna maximize, I'm gonna float and maximize the option chain, so we have it like full screen all the way, so we can just like see the beauty of it all the way. Okay. And I would like to start discussing a few of the views that you have, or a few of the sections, I should say, which are important. So first, notice how on the very top, this is where you're gonna be typing your symbol, or if you are not into typing, you may group the option chain with any other window you have on the platform. So when you change the symbol anywhere, so the option chain will also react to it. Okay. Where is it? So when you look at top here on the left, you have a button which says chain right there. Okay. So that's the button I clicked to open the option chain. Okay. Cool. So here we go. So again, I was talking about the fact that you can either type the symbol. For example, if I wanted to load a chain on Facebook, I would just type FB, hit enter, and now I am loading Facebook. Or if I link it, notice how my chart in the background is using the blue color. So it doesn't need to be the blue color on your computer, but in mine it is blue. So if I was to link it to blue, so now, you know, it's all in sync. Notice that everything is Facebook. My chart in the background is Facebook. The chain is Facebook. If I was to change the chain and I was to look at Microsoft, so then notice how the charts in the background are also changing to Microsoft. If I was to now click on the chart and change the chart to Apple, when I go back to the option chain, magic, it's changed to Apple. Why? Because it was linked. Okay, well, it's not that much magic. It's pretty obvious functionality, but again, just pointing at it in case you have not noticed that those options are there. Okay. Then next to the symbol, of course, you have a collection of data related to the underlying asset class, such as what's the current price of Apple in this case, and then a collection of different values for historic volatility as well as implied volatility. Okay. And again, this is indeed useful if you are into, especially if you are into non-directional trading or things like that, and you want to measure what a statistical range could be. If you want to observe, you know, the differences between what happened in the last few days versus what's happening overall in the last 180 days, which is kind of like half of a year. So you would, for example, in this case, conclude that in the last 6 months, the stock was traveling at a speed of 23.5% a year, where in the last 5 days, it's been slower than that. It's traveling at a speed of 18.25. So again, in my particular trading style, just to share, I don't pay too much attention to those values, because in the end, everything that has to do with volatilities, you could actually chart it visually with this tool, right? Which is a study which we'll discuss properly when the time comes, which is the probability cone or the probability envelope. And therefore, you can project those values in a way that is very visual. And I guess that, at least to me, I'm a visual person, so this kind of works better for me. But for other people, they prefer to see the values in a table format, and therefore, those values are there to serve this group of traders, which may be you. Okay, so again, all of this is non-editable. It's just you are being presented with information, and that's it. Now, second portion, okay, and let me take a look at the comments there. So no problem for no problem with Ahmed. You got out and got back in again. Okay, got it. Okay, all good then. Okay, perfect. Thank you, guys. Thank you very much for that. So anyway, so next section in the option chain is that portion on the screen where by default it comes as a long call. So if I close the option chain, let me close it, and I open it again, click on chain, okay, by default it shows a long call, right? And by the way, I can have multiple option chains open. Okay, I can have multiple option chains open, and you know, in this case, for example, I got 4. You can even maybe float them, float, 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 float. They're all floating, and now you can just position them in the screen however you want. You know, maybe you have a 4K monitor with a lot of resolution. Right now I'm using HD, so It's not going to look that neat, but maybe you have a very large monitor, either ultra wide or a 4K monitor or something like that, and you can position multiple chains in different positions of your screen if you happen to be monitoring, values of different symbols. So here I got Apple, then you may be looking at McDonald's, you may be looking at Pfizer, and you may be looking at Twitter. Okay, and you have all those different chains that are populating information. Okay, now of course, because I'm using HD, which I'm not saying is a bad resolution, but if you want to have multiple option chains on the screen, so again, I would recommend something like 4K would be better. But basically, in this case, you will need to scroll left and right to get full visibility of the chain, where with a monitor with more resolution, everything would fit on the screen. And this could be one monitor you use to monitor specific parameters that may be useful, especially as you will see later on. You can actually pick specific expiration date. You can even pick specific strikes. Maybe you're monitoring the 130 put, and that's the only thing you care about. So now in golden color, the 130 put is being highlighted, as you can see. I'll explain that better in a moment. But these could become very visual, and if you're looking for something very specific, it could also serve as a monitoring tool if that was your need. Okay, so you can have one or as many option chains as you want. You can have them from within the platform when you dock, so it's within the main application window, or you could have them floated, and therefore you can put them anywhere on the screen you want, or any monitor you may have if you have more than one monitor. Okay, cool. Okay, so let me maximize again, and let's continue with this. Got you, Mark. I'm reading your comment there. Cool. Okay, so again, we're talking about this upper portion of the screen where by default it comes as a long call. Okay, but it doesn't need to be like that. It could actually be customized to any of the strategies, right? Maybe you're looking for a bull call spread, so you can just click that and automatically we generate 2 rows with 2 options. Maybe you're looking for something a bit more complex, like a short arm butterfly, and now you have 4 legs, and all of this is set for you here, and then you can just edit and then customize the spread to whatever you want, starting with the expiration date and the strikes, call, put, etc., and you can get it organized right here. Now, this functionality that I am describing on the top of the option chain, to be honest, you may want to think about it like it's a widget that shows up in many places within top. Because if I go back to the main application window, and instead of the chain, I open, for example, the risk graph, which we'll discuss properly in a different session, notice that you end up with the same functionality here on the top, where I could have created a short iron butterfly from here and adjust it to whatever I want without using the option chain. So in classical trading platforms, and not so classical, actually, many of the ones that are considered modern these days, the only way for you to build a position is to do it from the option chain or something that looks like an option chain. Top is a bit more flexible in the sense that you could build positions from anywhere using that upper functionality, even though some of you may prefer to do it from a place like an option chain, because then on the top you get to see your position, and then below you get to see many additional values, such as break-even percentages, the theta, the delta. You get to see many things here on the bottom part that, depending on your trading style and your preferences as an options trader, your expertise, you may prefer it this way, or you may prefer to go the simple route, which is, okay, let's I don't need to see all that table with so much data, is confusing. Let's just say I want to do a bull call spread. I just select the strategy and I just pick the strikes. Okay, maybe I do 60 to 70. I click OK, and I got my trade right here, and I can see the Greeks, and I can see most of the things that you need as an options trader. So this is in the risk graph, which is a tool that we'll discuss properly in a specific session. Same thing happens if, for example, you are looking at the projection tool, which again, same story. We will talk about the projection tool sometime in the future. You also have, again, on the top of the projection tool, this particular widget where you can go ahead and build whatever you want. Maybe you want to do an iron condor, so you can just do it from here, edit the spread, adjust it from here, and all of this is without using the option chain. Okay. Again, just for you to know, this is out there in many other places from within the platform, even though today we are talking about it inside the option chain. One more place, okay, is also in the charts. So for example, if I activate options replay on the chart, which we'll talk about this as well in the future, notice that one more time you have the same tool here, okay, which if I leave it alone, I leave it as a long straddle, and now I get my simulation here. Okay, this is simulating options trades in the past. This is for backtesting options. Okay, we'll talk about this in the future. So you can see how this trade made some money there. So you can always right click, okay, and again one more time you have the same functionality here where you could have selected I wanted an iron condor on that date, you know, and you could edit your expiration dates and your strikes. You know, maybe you were doing June 2nd, blah blah blah. You click OK, and now you get your simulation. Again, one more time, all of this is done without the use of the option chain. That functionality is available in many places, okay, but it is also available in the option chain, which is what we're discussing today. Okay, so I'm going back to the option chain, just giving you a little extra detour to explain this upper widget that can be found in more locations. Okay, I'm gonna take a sip of water if you don't mind, guys. Thank you very much. Jose, can you please trade from there? Yes, you can. With my version of Top, which I'm using most of the times in the sessions, I'm using Top for QC. QC is not a broker, it's only market data. So in my case, I cannot because I'm not using a broker connected to Top. But in your case, Fernando, your version of the platform is connected to TradeStation. So you can come in here, and once you have customized all of this, or even here below on the platform, on the option chain, as I'm about to explain, you would be able to right click and you would have the top option on the menu, and you can try while we're in the session. It's going to be populate order ticket. That's going to be your first row, which I don't have it again because my version of Top is not connected to TradeStation, okay? But in your case, it is. So you would have an option here, which is populate trade ticket. So you can just right click and take the trade from there, which is super convenient. And most importantly, not only it saves you time, but also it saves you mistakes because you don't have to retype things. You see it. Wonderful, Fernando. Wonderful. Perfect. Okay. So now you know this upper part, okay, which by default, again, it comes with a long call, but it could be anything you want, okay, depending on what is it that you're about to trade, okay? Since I'm talking about it, and before I discuss the bottom part, which to be honest is the most important conversation to have today, I wanted to mention before we get into the functionality below that two important columns in the bottom part is the column bid and column ask. On the call side, on the put side, it's reversed. It's ask and bid, okay, because it's the put. So we thought of reversing it. I guess it makes sense. And the reason why those two columns are important not only is because they show you the bid and the ask prices, which are obviously the prices at which we trade, which are important. It's also because they are clickable. Okay, they are clickable. The prices that these two columns are clickable, meaning that if I look at the ask column on the 240 call side and I click on that, so notice what's going to happen on the upper widget. 1, 2, 3, click. Notice by clicking, I just added the December 17 240 call. December 17, as you can see, is right here. And 240 call, obviously, is that one, is the one I just clicked. And then it stays as highlighted in green color, meaning that you are buying these two. Okay, those are the two, the November 19, which is the one above, okay, and the December 17, 240 call. They are both highlighted because those are the ones that I have. If I edit the spread and I click on the excess, that's going to get rid of those options. And then also notice how what were green highlighted cells are not highlighted any longer. Okay. So, you know, it's a nice functionality because some of you, let's say you are building an iron condor, some of you may prefer to do this. Go to neutral, go to short iron condor, then edit the spread and change your strikes, which implies many clicks because you have to click on the expiration date, you have to click on the right strike, click on the next strike, click on the next strike. Again, it's a very valid way on how to do it, but some of you may be like, I don't want to do so many clicks. I just know I'm buying the 260 and selling the 250, let me clear. Sorry, guys. So I'm just clearing the top. So I'm buying the 260 call. So click on there. I'm selling the 250. Click on the bid column, and then maybe you are selling the 210 and the 220. So you click on the bid 220, and you buy on the 210 for the put side. Click on ask, and next thing you know, now you have the 4 legs that were added for you automatically here. Okay, and you didn't have to do too many clicks on drop down menus, which may take a little bit more time. So now, of course, this means that you know by heart what is an iron condor and what is it that you buy, what is it that you sell, and you know therefore exactly where to click. So maybe this is a time saver, but also a bit more advanced way on how to do it. We're grabbing the strategies from the top here, selecting what you want, for example, a long butterfly. And once you do that, just editing the spread and basically replacing the strikes. It's probably safer for a newer trader in the sense that it's almost like you are given a template and you fill in the template on, versus you've got, let me cancel, let me clear, you've got nothing in here, and now you know you are doing buy this one, sell that one, sell that one, and buy this one. Okay, and you know this by heart. So again, this is more advanced, is also quicker, and therefore there is no right or wrong. I guess it's all about user preference and experience. Okay, so I wanted to point at these bid and ask columns, which are clickable because they bring data to the upper widget, which is what I was covering, because I'm covering the option chain from top to bottom, but at the end, certain things are related. So that's why now I was talking about the bottom part. Okay, so anyway, let me clear and let me continue. Let me see, Ahmed, where is the midpoint between the bid and the ask? So it doesn't show us a column. Okay, it doesn't show us a column, but the moment you add anything on the upper part, so notice that you have the bid, you have the ask, and here is your midpoint. Okay, here's your midpoint. So let's say you are doing an iron condor. Again, I'm using the example of an iron condor just because it's 4 legs. So it's kind of like complex in a way, but then when you put it all together, it's quite simple. So I'm using that example because of that reason. There is no other reason really. So if I do this and this, so here's an iron condor, and you can see the midpoint for every one of the strikes. And you can also see the midpoint for the spread itself, which is 233 is the midpoint if you were to look at the whole iron condor as a whole, which is made of 4 legs. Okay, the ask price for the 4th leg would be 240, the bid price for the 4 legs would be 225, the midpoint is 233. And then if you are concerned or interested to find out the midpoint for a specific strike, so here they are on the column right here, which by the way, you can change that when you edit the spread. Okay, by default, it's going to show you the midpoint. Okay, but you could show, I don't want to see the midpoint, I want to see the last price. Okay, this may be a good idea if you are maybe simulating a trade when the market is closed, because the bid-ask spread before the market closes widens. So maybe when you are simulating a trade when the market is closed, you may want to simulate the last. Okay, and now next thing you know, well, in this case, McDonald's is quite liquid, so it didn't change too much. But now you get information about the last trade that was taken, which is in many cases more realistic than the midpoint between the bid and the ask when the market is closed. Okay, when the market is open, I would say probably the midpoint is probably the most fair value to be identified. Okay. Okay, so let's continue. Yes, Fernando, and I'm going to talk about the look back in just a moment, because as I said, I'm going from top to bottom. So, and also I'm going from left to right. Okay, so now from left to right, the first thing I would like to highlight is the fact that when you click on the multiple expiration menus, you have a list that shows you all the expiration dates available, or all the cycles that were listed by the exchanges based on the regulation, and also additional willingness from market makers depending on liquidity situations. So all of this is what's available on McDonald's. Every stock is a different story. Every ETF is a different story. If you look at the SPY got options that expires on the Mondays and the Wednesdays and the Fridays. So you're gonna have, the list is way longer, as you can see. Okay, it's not the case for all markets, even if they are very liquid. For example, Microsoft, very liquid instrument. Okay, you have many expiration dates, but you don't have Mondays and Wednesdays and Fridays. Okay, so what you see here is whatever is available. That's what you see here. Also, when you see a W next to the date, it means it's a weekly expiration date. And when you see no W, it means it's a monthly expiration date. That's what it means. What's the difference between monthlies and weeklies? Well, again, we can talk about this for an hour because there are multiple differences. Again, for traders, to be honest, it doesn't matter too much because in the end, options expires on Friday unless it's Monday or Wednesday, like cases like the S&P. It doesn't matter if it's a monthly or a non-monthly expiration date. In the end, expiration is on Friday unless there is a holiday and it's Thursday or something like that. But there are implications when it comes to liquidity, though, because traditionally speaking, the weekly expiration dates did not exist. And often, very often, we find much better liquidity on the monthly cycle, which happens to be, as you probably know, the third Friday of every month. In this case, November 19 and December 17 are the front month and the next month, and all the other dates following are also monthly expiration dates, but April 14, which does not coincide with the third Friday of the month, and for whatever reason, and then the other ones are third Friday of the month. So technically, they are monthly expiration dates. Okay, so because the greatest liquidity is normally found on the monthly expiration dates, by default, when you load a chain, no matter the asset, the expiration dates that will be not only available on the list but also check marked are the front month and the next month. Okay, those are the ones that come by default as a check mark. You could indeed select everything. Okay, you could indeed select everything, and now your option chain becomes very, very long. Okay, you are loading a lot of data too, and the option chain becomes very, very long. And now if I start scrolling down, this is now when the people that never traded options before are truly intimidated by options trading, because it's like they're, when I tell you options give you options, it is not a joke. There are many, many options contracts, thousands and thousands, actually it's millions, and therefore, it gets very confusing for most people. Even if you are very advanced, making a mistake in a table like this is so easy. So precisely to avoid making mistakes, the functionality of the option chain, it's there to help you filter out what you don't want to see and only display what you need to see. So let me change symbol just to change. Okay, so if I'm looking at Facebook again, by default, as you can see, it shows November 19 and December 17 in this case, which is again the next month, sorry, the front months and the next months. This is what comes by default. But let's say you are looking to do a trade very short term and you are only interested in checking the next expiration date, which is the one that expires on October 22nd. So if you were to only check mark this one, okay, that's the only expiration date that would be visible to you. Please notice the fact that you can see the date as well as the amount of days to expiration is right here. Okay, you can also see it here on the drop-down menu. Okay, the date, you don't see the days to expiration, but you see the date. And if that was the only expiration date you care about, or maybe you are only interested in checking a couple, for example, the front week and the next week, okay, the two nearest expiration dates, or maybe you are trading long term and you want to see leaps, so you want to see what's available in beginning of the year in 2023 and beginning of the year in 2024. So you would check mark those two, and now you are looking at January 20, 2023 and January 19, 2024. And that's the only thing you see. So everything else is kind of filtered out, is hidden. The information is available, but you are just not displaying it to, basically avoid mistakes on getting confused and then click on in the wrong place because there are too many cells. So that's a menu which is not only critical but very, very useful. And the next one in line, together with the one after, so the one that says 3 strikes versus the one that says select the strike. Okay, so those two, they go together. So I'm going to start with this one, and then I'm going to go back to the left to show you the one that says 3 strikes, because this one comes by default with a selection at the money. So in other words, it's going to be looking at the money strike. The current price for Facebook is 324.76. So the at the money strike is 325. Okay, and notice how 325 is the strike which is in the middle of this row, where we have 1, 2, 3 above, 1, 2, 3 below, and the at the money, right? And why is that displayed this way? Well, because I selected at the money, which comes by default, and I also got 3 strikes, which also comes by default. So in other words, by default, that's how it looks like. But you may not be interested in so many strikes. Maybe your strategy it's strangles, and you only care about 1 strike. Okay, so now you have the at the money strike highlighted with the blue and the purple, and then you have 1 strike above and 1 strike below because you have selected 1 strike. Or maybe you want to look at a wider range, like maybe you want 10 strikes above and 10 strikes below. And now if you were to count, so you got from 325 all the way to here to the top, you got 10 strikes above and 10 strikes below. So you basically decide how many strikes you want in the option chain, and you can even choose all strikes if you wanted to. And now it's all displayed, which again, now it's when we're back to this is getting confusing. Okay. Now, notice when you selected all strikes, then the amount of strikes above and below is grayed out, because then it doesn't make sense. If you show everything, then it means everything. If you show a specific amount of strikes, then that specific amount of strikes are dependent on a reference, which in this case is at the money. So at the money, current price, and then 4 strikes above, 4 strikes below. Okay. Now, all of this is pretty convenient, and I guess it's a valid default setting that when you load an option chain, you have a couple of expiration dates, you have 3 strikes above and below the at the money. That's probably pretty neat. But when you are planning on a specific trade, especially when your trading rules, because there are many ways on how to trade, and definitely even more ways on how to trade options. So maybe your trading rules have you come from the charts into the option chain. Maybe you are using UFOs, for example, and you have a UFO at a specific value. So you have 141 there, for example. So you know, and here you got 146. So just to, you know, I'm not talking about trading here. I'm just picking 2 values randomly. So maybe your trading methodology has you focus on 141 and 146, and therefore what you want to display on the option chain on the option chain is 141 and 146, which, by the way, that was Apple. So I'm gonna go back to Apple here, and I was looking at the 2 nearest expiration dates, the from week and the next week. And if you are only interested in those 2 strikes I mentioned, so one very good practice would be to select 1 strike only, and next to it, you would now go ahead and select the very specific strikes you care about, which I believe I said 131 and 146, and you can disable at the money. Did I say that right? Oh, it's 141 and 146, not 131. I went too low. Sorry, my mistake. 141 and 146. And if you do that now, okay, notice how the 141 has been highlighted in golden color. The 146 has been highlighted in golden color. All of this is referring to the October 22nd expiration date. And same happens with October 29 expiration date. The 141 is highlighted in golden, and the 146 is also highlighted in golden color. So now, you know, your eyes, you know, you train your eyes to go to that very specific value, and that way you don't make a mistake by, you know, mistakenly look at the wrong row just because you had too many rows on the screen, okay, and nothing was highlighted. So those are the reasons for those filtering tools. Again, it's quite intuitive. You know, maybe you have played with this already and you kind of self-discovered the functionality I just discussed, but you know, at least now it's official. You know what this is for and how it works. Okay, so I need to talk about the look back now, but before I do that, I'd like to get some feedback from you guys. How is it going? Please let me know if all of this is well understood so far. And Fernando, where does no one see the expected move? Yes, I know where your question is coming from. In many platforms, next to the expiration date, somewhere here, you may get a percentage value, and out of the percentage value, you also have a dollar value which represents the expected move. Okay, we don't have that in top, and the reason why we don't have it is because it's not precise enough. Okay, it's not precise enough. It's a good reference, don't get me wrong, it's a very good reference actually, but it's not precise enough for you to take a trading decision that leads to more success. So the way I would suggest, Fernando, if you want to find out more about the expected move, is that you get into a chart, okay, and I'll discuss that in a future session, but here I got what is called the probability envelope, okay, so I got an indicator here called probability envelope. In this case is the cone, the envelope is only one. In my case, I'm using the cone, which is 4 calculations. And the 4 calculations I have are, number one, an expected move based on historical volatility of 63 days, which is 3 months. An expected move based on historical volatility based on 42 days, which is 2 months. An expected move based on historical volatility based on 21 days, which is 1 month. And an expected move based on implied volatility of the CIV mean, which is the real-time implied volatility overall across multiple expiration dates, which you can even bias to be call only or put only if you are being directional. Okay, and that it's very likely going to produce a much more precise result than simply looking at the expected move from an option chain. There are many reasons for that, but for example, let me show you here, and let me close this window and you will see why. So I'll discuss this tool better in a different session, okay? But this is the skew tool. So let me load a stock, for example, CLF, which is an okay company, but not the most liquid company in the world. So what happens when you load a company which is not the most liquid company in the world? And I'm using multiple expiration dates, okay? So compare CLF with Apple. Okay, so if I look at Apple, which is very liquid, you can see that even though the market is closed, and this is the worst time to do this analysis with a skew, because when the market is closed, the bid and the ask widens, and therefore the values of the options is a bit distorted. So now, even though the value of the options is a bit distorted on the close, you can see that the volatility graphs that we are plotting here when we look at the option skew, it's basically it's almost like a book volatility smile, which is very continuous type of drawings that do represent a very clear volatility smile, which is the normal thing you find in options trading. Again, we'll talk more about this in future sessions, but this is quite normal. Again, if I go back to CLF, which is less liquid than Apple, so notice what happens. So those volatility smiles, they have sometimes random points which look like, if I was to look at this, let me only leave the light blue. Okay, so if I was to look at the light blue, and I was expecting this to be a volatility smile, so putting on the side that I'm not the best person at drawing with a computer mouse, but a volatility smile will look something like that. So how do you explain this point that is all the way on the top? How do you explain this point that is all the way on the bottom? Well, again, it may be a price anomaly, which is a good advantage for a trader, but no matter if it's a price anomaly or it's the product of the fact that options prices are distorted given lack of liquidity, the reality is that for the options pricing model that runs in the platform or any other platform, that particular strike, it's currently providing 73% IV, and therefore your expected move would be calculated based on that 73% IV, which is completely distorted. So now your expected move is distorted too. Okay, so that's why while it's a good reference to have expected moves on an option chain, it's not ideal. Okay, and if I was to show or discuss one preference I have, I would prefer to use the probability cone, because with the probability cone, now not only you can get your implied volatility, but it's in the format of continuous implied volatility, meaning that you are looking at multiple strikes, multiple expiration dates. There is a weighting factor, times the amount of delta. Well, there is a series of things to make this calculation very robust and very solid, no matter if the underlying is more or less liquid. And now when you project that, okay, it's going to give you expected ranges, okay, based on your expiration dates, which are highlighted with those vertical lines. Okay, so here you got October 22nd. The next vertical line is October 29. The next vertical line is 11:05, which is the next expiration date. And therefore, if you wanted to know what is the expected move on 11:05, you just come in here. Okay, and as I put my mouse on 11:05, so the expected move now is for the stock to either reach 154 or reach 134, 135 on the bottom part. And that is a more precise way to understand expected moves than just looking at it on the option chain. Apart from that, in this case, as you saw, I am also looking at not only the red line, which is the continuous implied volatility, which I'm plotting in red color, but I am also looking at the expected moves based on historic volatility, which, if I was to phrase it differently, that would mean that you are projecting what would happen if the stock was to behave the same way it's behaved on the last month, on the last 2 months, or the last 3 months. So if the stock was to move at the same speed at which it's been moving in the last 1 month, 2 months, or 3 months, so then in that future date, you would be at that certain level, and that's your expected move based on historical volatility compared to the expected move versus expected move based on implied volatility, okay? And there are cases where the red line is beyond the blue lines, but there are also cases where the blue lines are beyond the red lines, and you don't see the blue lines on the option chain. You would only see the red line, even though it's not calculated in a way that is that robust. Okay, so just for you to know why it's not there, we may add it someday, just because it could be a reference, but the underlying suggestion, if you wish, or preference coming from me in this case would be that it's better to work your ranges on the chart than on the option chain. Okay. On probability, why the date is July? On the probability, why the date is July? I'm not sure where you are looking at this moment in time. On the calculation date, I don't see July anywhere here. I am not sure I follow your question, Ahmed. If you could rephrase it, I'd love to understand better where you're going, because I'm not getting where you have dates at the moment. I got nothing related to dates on the screen apart from the expiration dates. But anyway, while you are typing this, I'll start getting into the look back, which, by the way, the look back is about dates. So maybe your question is about that. So now, all of this, everything that we've discussed concerning the option chain, it's about you are today planning on a trade and you are ready to take the trade, okay? Today, on the current date. But what if what you're doing is back testing? Or what if what you're doing is to just go back in time to understand, certain behaviors and certain stocks, maybe because, you're looking at what happened before earnings, after a news announcement, whatever. You want to see more about those options prices on a past date. Well, you have multiple ways to deal with this, because the first thing is that you could pick any option, for example, the 145 call that expires in October 22nd, and you can go ahead and chart the option. So you can do that. So if you chart the option, so now you get a chart. Okay, that chart is the option. Okay, it's a daily chart. You can make it whatever you want. So if you want to make it a 5-minute time frame, so here's a 5-minute time frame of the option. You can even see your UFOs for that call, because what I'm charting now, it's the 145 call. I'm not charting Apple as a stock. I'm charting the 145 call. So if you wanted to know everything about the call through time and you were curious about what happened on October 12 to the price of the option, so you can go ahead, chart it, and find out more about that. Okay. If you wanted, going back to the option chain, to know more about what's going on to this option compared to the underlying, so you can chart the underlying with the option. So now I'm gonna get Apple and the Apple call together. Okay, and again, by default, it comes with a daily time frame. So let's say I bring it down to a 5-minute time frame. Could be anything really. So now on the top, it's Apple, the stock, and in the middle here, that's the options price. Okay, that's what the call did while Apple was moving. So now you can have a very neat comparison. You can also have, volume, open interest, all of these You can maybe move it down to save space and get a bit better visual. But again, this is probably very useful for you to go back in time and get to understand what happened, to a specific contract in the past. Very good question, Mark. And Ahmed, I'm going back to you with the probability code in a moment. Can you chart spreads? The answer is yes. So notice how you have the comparative chart here, and here you have the option symbol, which, by the way, my symbol is at Apple, blah, 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 blah. If you're using top for TradeStation, your symbol will be a different string. It's going to be similar, but for example, it will not have the at in front because different markets provider will provide symbology, which is different nomenclature. So you need to know your stuff there. But as a rule of thumb, you don't need to make it too complicated. You can just copy paste. So let's say this is the 105 call. Okay, this is the 145 call. So let's say I wanted to chart what happens if I did the 150 call against the 145 call long. So buy the 145, sell the 150. So what if I wanted to chart that, which I believe that's your question, Mark. So the way you would do it is just double click on this header, and here you have the symbol. Okay, here you have the symbol. So make sure you move all the way to the left. So now you can select all the way to the right and right click and copy. Okay, and once you have done that, okay, to create a spread formula as a symbol, you will just need to remember this. Okay, you need to use an equal sign first, like a mathematical formula, and then type the symbols of the options you buy, in this case the 145 call, and then use the minus sign for selling. Okay, so plus sign is for buy or nothing, minus sign is for sell, and then you would sell the 150 call. Okay, but now instead of only 145, 150, you need to paste that whole string. Okay, so let me do it. I'm going to add at the beginning the sign equal. Then I have equal at Apple, blah, 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 all the way to 145. Then minus. And then I'm going to right click and paste. Okay, and because I'm selling the 150, I'm simply going to edit that 145, make it 150. And when I click OK, here we go. Now you have the spread that is being charted, which is the result of buying the 145 call and selling the 150. Notice the equal sign at the beginning. Notice the minus sign in the middle. Okay, and if you're doing an iron condor, for example, and it's 4 units, so you use plus and minus for the options you buy and the options you sell, and you can have as many as you want. Okay, cool. Okay, so hopefully this helps and answer more questions. Now, since I'm looking at the charts, I'm gonna go back to Ahmed's question. So I was looking at edit study probability cone, and you mentioned July. Are you referring to this date? 7/19? Yes, Fernando, you're right. This is a powerful functionality. I appreciate your comment very much. Guys, I'm super excited about the platform, and I'm even more excited when I see you guys are excited. So thanks for that. Yeah, so this is grayed out. Okay, so it's grayed out. I cannot click it. Okay, and the reason why I cannot click it is because I have checkmark follow last bar. Okay, so again, today we are not talking about the probability cone. So if that's okay, I'll keep going with the option chain. But just know that you could have the probability cone in a prior date. So you could select any prior date, could be July, could be last year, and you could plot your probability cone and see what happened in the future. But in this case, I'm following the last bar, meaning that that is just there because probably that day was the day when I inserted the indicator in the chart, and top remembers, but it's grayed out and ignored because I have checkmark follow last bar. Okay, so this is not into consideration at this moment in time. Cool. Okay, so back to the option chain. Okay, so now we know the option chain is real time. We know we can right click and chart it. We know we can see prices in the past, including intraday. One thing, keep in mind that if you are utilizing TradeStation as the market data provider and you are doing this with weekly expiration dates, I believe, and this changes through time, so TradeStation will need to respond and confirm, but I believe that TradeStation keeps 1 or 2 weeks of market data for weekly expiration dates, meaning that if you try to chart an option like I did a moment ago, and you want to go back in time 1 month ago, but it was a weekly expiration date, you won't get data because TradeStation doesn't keep that data. Okay, with top 4 QC, I would have it. Why? Because QC does not delete the data and they keep it. So I could chart intraday data for options going further back in time, right? Again, every market data vendor got their pros and their cons. Also with QC, I cannot place order. With TradeStation, you can. So I think that with TradeStation, you are indeed in very good hands. But just know that in case you try and you're like, I got no data. How come Jose got data and I got no data? Well, remember, TradeStation doesn't keep intraday data for options after like 2 weeks or so when the contracts have expired. Okay, but what about the look back? Okay, because the look back is going to be your solution for most of the cases. Okay, because getting into intraday chart of options, I guess this is really fine tuning, which I'm not saying don't do it, but probably is not your first pass. Okay, probably your first pass is to look at backtesting methodologies using, one price point per day or something like that. And maybe you're wondering, what if I did this trade last 15th of July, right? And then you see the result instead of what if I did this trade last 15th of July at 3:45 p.m. So that's maybe just a bit too exaggerated at the beginning of a backtesting process, even though maybe in the end you want to go that fine. Okay, so that depends on you guys. So if you are looking for end of the day data, okay, so one price point a day, that's when the look back comes into place. So if you wanted to find out more about what happens with Apple on, I don't know, I'm just going back in time, January 10, that's Sunday, sorry for that. January 11, that's Monday, okay? So you just use that look back function, click on January 11, and then it brings the option chain to a point where it's like if it was January 11, 2021, and you can see the date here. So now when you click on the menu and you see what's available from an expiration date point of view, the same applies. So by default, you are going to be given the front month and the next month, where if you wanted to use other dates, you could, okay, any other day you want. And then, you're going to be given whatever strikes were available at this moment in time. You're going to be seeing the last trading price of the day on that day, January 11. And, you can do, you can do whatever you want on the option chain and observe all the data, knowing that data now belongs to that past date. Same story, you can right click and chart the option, chart the underlying with the option. All of these you can do it, but remember what I just said, that if you are using very old data, you may not have it available. Okay, even in this case, even with QC in this case, that data is gone. It doesn't show. Okay, why? Because it's too further out in time. Okay, so market data vendors, they don't keep everything, even though like the monthly expiration dates probably they will. Okay, depending on the stocks. So again, it's a little bit of what if, depending on the market data vendor and what they feel is more important to keep and not, because again, it's millions of options contracts with dozens of strikes. So it's crazy amount of market data. Okay, so somehow it's understandable that they don't keep everything, but at least with the look back, you have a very simplistic fashion to go back in time and see what happened. Okay, so that way you can understand a methodology much better before you execute it. Very good. So Mark, one can do options and credit spreads in TOS. I don't know about iron condors. You can do options and credit spreads in TOS. You don't know about iron condors. What do you mean, Mark? You mean like getting it on an option chain, or I'm not sure what you mean. I'm sorry. Fernando, my first pass was with you in OTA many years ago. Yes, Fernando, I remember that. And of course, that is, these are times in my life that I keep with such a special memory. I started myself with that particular academy as a student in 08. And then I had the the opportunity um, to develop myself as well as sorry, I was reading the chat box, to develop myself as well as a trainer and get to meet many of you. And um, yeah, I have amazing friends over there, and it's really special time. So I so appreciate that comment, Fernando. Mark, charting, got you. So I would not be sure about that, Mark. I would think that you could not do iron condors either. Okay. Anyway, so this is the lecture on the option chain that I wanted to go over today. If you have any questions, just let me know. Now I'm gonna switch topic, unless you have questions related to the option chain. I need to take a look at a couple of questions that Mark sent me, so we can talk about it. So again, if in your case you were exclusively interested in top, so and you have to go, I would understand that, but I'm just gonna spend a few minutes going over a trading question from Mark when it comes to management of a trade and so on. Okay. Any question about the option chain before I begin with the trading question? It seems that no question. Very good. So I guess this is good. I'm looking at the different chat boxes. Everything seems okay. Great. Okay. So I guess that we are then done with the option chain. Okay. And what we're going to do now is to look at Mark's question. Okay. And for that, I'm just going to move into a daily time frame of the Russell Index IWM. This is where I'm going to start. I did some marking already here on the IWM. This is March 18. Okay, this is March 18, which is the date in which Mark took a trade. And Mark, please feel free to correct me if I am wrong on what I'm saying. But I believe that this is where you took a trade. I'm not sure exactly about the price of the IWM when you took the trade, but the IWM was falling. I believe it was falling relatively hard, and you decided time to get in. It's probably a continuation of the move from there after this retracement. But instead, you just experienced a very, very lengthy, problematic sideways market. And you got into this trade using a leap. So let me simulate that here. So you bought a call, which is the 235 call. Please correct me if I get any of this wrong. The 235 call you bought expires on the 18th of March 2022. And for that call, you paid 20.5. Okay, so and I believe you got more than one, but if that's okay, I'll do the simulation with one. So then if it's 2, 3, whatever it is, so you can just multiply it. Okay, so this is your trade. Okay, this is your trade, which if we look at the current P&L, well, obviously this trade is not looking too good at this moment in time. This trade looks to be looking like losing about 1,300. We are dealing with a situation where the current price of IWM is more or less where I would guess your entry was, kind of. This is correct. Thank you for confirming. So in that sense, if that was a stock, then you would be basically breaking even. But because it's an option and options lose value on time passing, then you are suffering, the consequences of a sideways market. Okay, and on top of that, the implied volatility went down by a lot. So if we add volatility comparison, I'm just gonna show implied volatility only, red color. So if we look at the implied volatility on the day you took the trade, this was 28% volatility, and the last trading day, the volatility for IWM was 16. So you suffered a 12% decrease in implied volatility, where you are positive Vega. So when volatility drops, you get hurt at a rate of 55 cents per 1%. You dropped by 12%, so you lost 12 times that. And on top of that, the time decay that is hitting your trade times all the amounts of days since March until now. And therefore, this trade is looking pretty much out of shape with $1,300 of loss at the moment, okay, in the P&L. Okay, so your question is, I have that in my account. What can I do to help? I believe that's your question, correct, Mark? Can we manage the trade in any way to try to offset the problem that this trade is implying? So let me know if I'm right or wrong on that assumption. Correct. Okay, good, perfect. Now, there are different things that we can do. We can do magic, obviously, but there are different things that we can do that may help. But that also depends on what's your outlook. Because my question to you would be, what was your outlook when you entered the trade? What was your target? Or you were going to enter and let's see what happens, or did you have a target? Because if you didn't have a target, I would like to know what was your target. And if you didn't have a target, well, now in order to do something about the trade, we're going to have to set a target, because tweaking the trade, doing any sort of management for the trade may help, but would only help under certain circumstances. So if your target was to be located too far away, then forget about it. We're not going to be able to help because the trade has been hurt for too long. And if you still plan to reach that further target, the best thing you can do is just stick with your plan. And it's either you lose 2050, which is the cost of the trade, or the market will continue and then you'll reach your target and that's it. The target was approximately delta, and that would be what price value, because if I chart delta here, so if I add delta, okay, so 80 delta is somewhere here, okay, which is 257, okay, so 257 is when delta will be 80, okay, and yeah, I'm just double checking everything. Yes. Now notice that if you reach, let me see. Yes, correct. So if 257, I'm looking at this correctly. If you reach 257 today with no more time decay, okay, the P&L of the trade, it's going to be $625. Okay, so this is the P&L of the trade if you reach your 80 delta. Now the question is it doable to hit 257? I mean, anything could happen anytime, but is that realistic? Okay, because 257 realistically is up there, right? So let's take a look at the probability cone. Okay, knowing that your expiration date, it's all the way on March 18, which is right here. So statistics suggest that you may reach 259. Okay, you may reach 259. So in other words, you may reach your target, but I would say, I don't know if you're with me, Mark, but it's a little bit of a stretch. Like, it's like that stock needs to behave in a way where the most that is expected is met, but $2, because the difference between 259 and 257 is $2. So while this may have been a valid plan when you plan the trade, given what happened to that stock, the time decay, the time that has passed, etc., etc. So now keeping the same target, in my mind, would not make sense. I think it's a bit too greedy, if I can say that. Okay. Now, on the other hand, if you want this trade to be profitable, the minimum target you can have is about 250. Okay, and 250 means you're gonna make $100. It's not like you're gonna make a lot, but if you exit the trade below 250, then you're gonna lose. So if you want this trade to make some money, so I guess that at least 250, should be your target. So what will happen if I look at the highest high, which is the all-time high for that market, and I was to project a target? Let me do this again because I didn't click properly. So let me go ahead and zoom in so I can click this with more precision. So if I project what the target could be, okay, so yeah, 250 seems to be doable, but notice that 251 is the top of the top there. So again, having that target as a 80 delta, while it could make sense based on some methodology, in my mind, it's very complicated. And in order to repair the tear, in order to try to repair, and I hate to use that term, in order to try to help the trade, to try to tweak the trade, to potentially make some money, and if any, lose less, I would definitely not shoot for anything higher than 250. Okay, because I think that would not work. So my question to you is, I'm gonna try to find a way to help the trade, but that would imply to set the target to be 250. Are you okay with that, or that's not good enough, and then you prefer just to leave it alone to see if one day you would reach 257, which is your 80 delta? What would you say to that? I will need that answer from you, okay? And I know there's a bit of delay, but I will need your answer, because again, we can try to help, but we cannot do magic. When a trade goes against you, it goes against you. So you're okay with that? Got it. Okay, so how can we try to help the trade? Well, one way we can try to help the trade is by creating a broken wing iron condor. Let me say that again: broken wing iron butterfly. What I'm gonna do, and by the way, I'm gonna make it non-iron. I'm gonna make a broken wing long butterfly. So I'm gonna go ahead and sell at the current price 2 of the 250 calls. Okay, and the distance between 235 to 250 is $15. So what I'm gonna do is, above that, I'm gonna buy another call, but instead of using $15, which is 265, I'm gonna use double than that and see what happens. Okay, which is gonna bring me to 280. Okay, so let's do that and let's see what the chart looks like. Okay, and this is not helping. Okay, it's not helping because notice that the whole PNL graph is under the red zone. And the reason why is because the 250 call only pays 298. Okay, so in order to offset some pain from this option, I'm gonna have to go way closer to 235, and I'm gonna end up saying, Mark, that I don't recommend it. It's looking very tough, to be honest. Let me try something and explain to you why I think it's not gonna work. If we do 250, so I got $5 and $10. Yeah, so everything still looks red. Why? Because the 240 call only pays 566. So again, the problem is that because of the drop of volatility and huge amount of time that passed from March until October, and you haven't done anything to help the trade, so then basically the options have lost so much value that now, even if I sell 2 calls against the call you own, the amount of premium that I collect is so little that it doesn't really do much. Okay, it doesn't really do too much for me. So in that sense, the only thing we can do here is to alleviate the problem. Okay, we can alleviate the problem, but we cannot remove the problem. And alleviate the problem means losing less, but alleviate the problem doesn't mean putting any scenario where you can profit some. So in other words, you are locking in a loss, which is going to be 1,200 instead of 2,000 plus, but that loss is locked in. Okay, which I don't think that's what you want to do. Okay, so what is another alternative? Since the stock has moved against you by so much, what is another alternative? Well, there is another alternative which may end up helping, but it will consume a lot of your buying power. So that is something for you to assess, because you may have or you may not have buying power in your account. If it's your investment account, maybe you have plenty of positions and your buying power is already maxed out. But if that's not the case, something you could consider doing, it's looking at the current delta of the trade. Okay, so this trade, the way you have it now, has a delta of 40. Okay, so something you could do is you could short 40 shares. Okay, per call. If you have 2, double. if you short 40 shares at the current price, so this is what's going to happen. Worst case, okay, on the expiration date, you're going to lose 2,400. Okay, so you are adding a little bit of risk. Okay, but if the stock moves by a lot, meaning the world ends and the market crashes and crashes below 173, okay, which 173 is a very severe crash, okay, because it's all the way here. Okay, 173 is a very big crash. So if the market was to crash a lot, so now you are actually going to start making money on the way down. If the market was to rally and surpass 277, which is also very, very high, now same story. Now you're going to start making money on the way up. But if you stay somewhere in between, so depending on where the market is, let's say the market reaches 250. So at 250, on the expiration date, you will lose 1,500, which is less than 2,050. So basically, you are adding hard deltas against your short delta, against your soft delta. But the problem is that you've waited so much to do this that your call lost so much value. It went from $20 to $7. That now adding the hard deltas, it could help, but only if you were to have a monstrous move, either up or down on IWM. So to be honest, you know, you are a bit stuck, okay? And it's just because you spent too much time waiting to see something was going to happen, which, I mean, I could understand this, you know, it's a methodology you were experimenting with, and you didn't act based on a specific plan. You were just watching, and I get it. It's, you know, part of trading, and when you experiment something new, this may happen. I'm not saying this is something that you have done wrongly or anything like that. I'm just saying that the consequence of so much time decay and volatility dropping, even if the stock is basically where your entry was, basically, you know, you are underwater by too much, and you cannot do too much to help the trade. So my way to approach this, since, you know, we didn't act on time on this because it's all about timing, so would be to wait, okay, and wait until the stock either drops by a lot more, and then add a hedge with shares against the position, or wait for the stock to rally more. And if the stock rallies more, then your 7.5 may become, you know, 10, 12, 15, and then converting this into a butterfly, broken wing butterfly, may help to reduce the risk by a lot and allow you to make a small profit by exiting sooner instead of shooting for that 80 delta target. But right now, after everything that happened and where the stock is at, there is not too much we can do. We cannot do that much magic to help this trade to a level that doing something actually makes sense. So I'm just showing you two scenarios, but really, I'm not too convinced by the results that those scenarios provide, okay? If you sell calls, okay, you reduce the cost. But by how much, right? By how much? So if you take the 235 call you own and you sell the 240, right? $5 above. So you know the more you will make is $5. But that trade will lose for you. Why? Because you're gonna get paid 5, and the distance between strikes is 5. So in other words, if the stock goes all the way to 240 and even beyond 240, the most you will make is $5, but this trade cost you net 20 minus 5, 14.84. So in other words, you are locking in a loss of 1,235, even if the stock rallies all the way. Why? Because these options lost so much value that is not going to work. I mean, I tried earlier by selling 2 and it didn't work. So by selling only 1, it's going to work even less. So now, can you do that with shorter expiration dates and just keep doing it? Yeah. But what if the stock rallies? Now you're going to be in trouble, because, you know, if you do this with, let's say, November 19, you sell the 240 call, I mean, you're going to get paid pennies. You get paid 58 cents. Now, if the stock rallies, shares are going to be assigned and put to you, called away from you, I meant to say. You're going to be short shares. And you are underwater by $19 where you only made $5. So this would only work if you are lucky, and from now until March next year, you keep selling calls and they always expire, and you never got a sign on those calls, and you just keep selling them, and that would diminish the cost basis of the trade. And now when you get to that future expiration date, you may end up with break even or more, or even a profit. But what if the stock rallies hard above 240 before November 19th takes place? Now you're going to be assigned shares short, and now you are stuck with a position which is very problematic. So yeah, it's difficult, Mark. It's just too much waited time, and therefore those calls have just lost too much value to be able to work with them in a way that could be productive, and therefore we are stuck there. Okay, so yeah, so the solution, which is not, would be wait, and what's going to happen hopefully is no more sideways markets, and what's going to happen hopefully is a push either up or down. And if the market drops a lot more, then you can get into short shares, which is going to cost you less money, because if the market drops, delta is less. So hedging that is going to cost you less shares, because instead of 40 shares, you may need only 20 or 10. And then if the stock bounces back up, those 10 shares are not going to hurt, and the call is going to start paying sooner. And if the market falls, then the hedge to the short side is going to pay you better. So you could do that. Okay, you could do that. But where you are right now is not useful. You are basically in the middle of nowhere. And if the stock rallies, same story. If the stock rallies, your calls are going to gain value. So now selling a call against your call or doing a butterfly, that could help because the calls got more value. But right now, it's kind of like, it's almost like, I mean, we picked the best day to have this conversation, even though it's not a happy conversation for you, Mark. It's part of trading in the end. But at the same time, we picked the best day to talk about this, in the sense that it's the worst day to do anything, right? So it's the best day to talk about it. So you watch it, and when a move happens, okay, let's talk about it in the sessions, and we can think about how to help the trade the best we can, knowing that we're not magician, but indeed there are ways to help the trades that many times we have exploited. It just happens to be that from March 18, when you enter the trade, all the way to today, is way too much time for a sideways market that just basically killed those calls. Okay. Anyway, you had another question about SPY, but if that's okay, Mark, I'm going to skip it because it's the very same story. Okay. You entered in a different date. That was in September, but to be honest, it's a very, very similar problem. So we need to wait for a move to then be able to work and help this trade better. Okay, cool. So all understood, Mark? Is it all understood? Maka, thank you so much for this comment about the trade management. Yes, I mean, the top sessions, first we need to give priority to the platform, because there are so many things that we need to discuss about the platform. But at the same time, as I said at the beginning when we started today, I cannot separate the use of the platform and trading. So for sure, if you guys have questions, I'm more than happy to talk trading apart from talking platform. But we'll start the sessions with the platform first. So, you guys can also get the proper technology support. And for sure, you can also ask these questions in the trading days when we do Wednesday and Thursday sessions as well. Okay, so don't be shy to ask questions, and even send me an email ahead of time. Okay, for sure, guys. Very good, everybody. I didn't see your response, Mark. I guess that is because you are with me. But again, I would really like to get an okay, so I know you got me. Yes, SPY is in a better position. Okay, it is, because you started in September 14, right? So September 14 is here, right? So you are in a better position. You're kind of back to where you were before, but same story, right? So when you enter this trade, implied volatility was 14. Implied volatility now is 10. So you lost money on time decay. It was a sideways market, less longer duration, because it's only September instead of March. So you are in a very, very similar situation. Okay, so it's going to be very difficult to have this trade. Okay, very difficult. I mean, I don't mind to take a look deeper, but again, in this case, instead of asking you where you would see your target to be, I'm just going to project that, okay? And let's say you plan your target to be 465. So what you have with Spider that was entered on the 14 is you have a June 2022 445 call that was filled at 25.97. That's what you have. Okay, so this call, it's, you know, in a less problematic situation, as you said, so you are basically underwater by $10, okay? You have a fair probability of breaking even or better if your target is 470 or less, okay? 470 or more. And therefore, 470 happens to coincide with the top of this. So I would, feel that it's an intelligent move to work on 270, okay? But now, okay, so let me add it first and then I'll share my thoughts. So if you do a butterfly here with 470, okay, so you do 445 to 470, and this needs to be midpoint and midpoint. So if you do 445 to 470, this is 25. So if I do 50, that's going to be 520. So if I do something like that, this converts my trade to be something like this, where now, if you're wrong on the trade, you're going to lose 309. That's the worst case. And now if you get to 470, you can make up to $2,000. Right? Now, of course, if it keeps going higher, you need to close it, because notice if it surpasses 491, now you start losing money, okay? Now, what's the issue with that? I would not be very happy to do this, to be honest, even though it looks very nice in the chart, okay? Because you go from a $2,500 risk trade to a $309 risk trade, so that's nice. But I would not be happy to do it like that, because since this is a long-term expression option, the way on how this PNL line is going to move up is very slow. So let's say you get to 470 in 2 weeks. Okay, so 2 weeks is 1st of November. So notice on the 1st of November, your dotted line is basically in the same place that it is now. So in other words, you will get to your target and you will lose, on the 1st of November, you will lose 194. Why? Because the time decay of our long-term expression option is very slow. So this is not really helping you. It's not really helping you, right? So then in that case, then if you wanted to do something to reduce the risk, then the only way that could make sense is actually your suggestion of doing a bull call spread. So sell the 470 against the 445. And if you were to do that, now you're in a trade where worst case, instead of losing 2,500, you're going to lose 1,369, and best case, you're gonna make, actually we can see it here, much better. So best case, you're gonna make 1,130, okay? But now, was that your plan when you got into this trade? Okay, was that the plan? Oh, you got to feel 26.97, I got it wrong. Okay, but it doesn't matter, it's $100 extra, okay? But anyway, so, I would not be too happy with that, okay? Depending on the original plan you had. If you just bought a long call, I'm guessing your target was much further away, and given the fact that you are breaking even, so why wouldn't you leave it the way it is and see if you get to your target, if you had a reason for that, unless you were experimenting. So if you are in damage control mode, okay, so then step one, you could do that. Sell the 470 call, okay? Using the same expression date. That's what I would do. And then, if it continues working against you, so then you can then convert this vertical spread into a long butterfly. And you can do a second action on managing the trade. In this case, you can afford such a luxury of doing it in 2 steps instead of 1 step. But don't go for the butterfly all the way, because with the long-term expiration, is not going to pay you fast enough is if the S&P breaks out and starts making all-time high. The plan was to double the premium. Okay, yeah, but that's great to say, Mark, but technically speaking on the chart, did the technicals tell you that was likely going to happen, or is just a wish looking at the Greeks on the option chain? Because that's how do I put it? Again, I don't know the methodology you employed, and maybe it's a very fine one. There are many ways on how to trade. I don't mean to be negative about certain approach on how to trade. I'm just saying there is a dangerous aspect of looking at the option chain and be like, I'm going to double the premium. The dangerous aspect of it is that saying yes or no to a trade is a matter of greed instead of a trade plan where you have a reason why this is going to happen. Okay, so if you have a plan, I'm great. But if you don't have a plan, careful. And if you have a plan and it's based on the trend, as you are saying, so what are your technicals telling you about the trend based on the analysis you did that day? Are the technicals telling you you are still in an uptrend or not? If you are, then why would you change your plan? And if you are not, then go ahead and tweak it. And the way to do it would be selling the 470 call could be a good idea. Okay, but again, I have limited understanding of the methodology that you have used to get into this trade with a long call, long term only. So those are the thoughts I can add that hopefully help you. Cool, everybody, my friends, we extended the session by additional 30 minutes, so I'll let you go enjoy your Sundays. Thank you for joining me today. Keep up the good work as always. Pleasure spending time with you, and looking forward to the sessions on Wednesday and Thursday next week. See you then. Take care, everybody. Thank you, Maka. It's my true pleasure, believe me. Thank you. And thank you, Mark, for sending those questions. And not only for that, but also being open that I could discuss them publicly with all the detail, with your price points and everything else, because that, believe me, it helps as well other traders in the community. So thanks for being open, because sometimes, some traders will feel that, it's their little secret, which I could understand. But it's very kind of you as well to open up, because not only it helps you, but it also helps others. So thanks for that, my friend. Take care, everybody. See you soon. Bye-bye.